Many Canadians are bracing for more pain in their pocketbooks. The Bank of Canada has raised interest rates again. Scott Peterson is following the story for us. Okay, so was this move made in an effort to contain the hotter than expected economic growth?
Yeah, there's a simple tool. It's basically a switch. And Tiff Macklem, Bank of Canada governor, switches it up, makes interest rates higher. To cool spending, switches it down to make money less expensive, and that speeds up the economy. So what we're witnessing today is his saying that, the economy is still too fast, and I've got to raise the rate to make people spend less and make borrowing more expensive. I'd like to dig into some of the statements that he said, that just saying that the overnight rate, that major banks are raising their rates to contain inflation, and globally, I should say, consumer price inflation is coming down, but not as much as the bank would like. And also the bank saying that they decided to increase this rate because monetary policy was not sufficiently restrictive to bring supply and demand back into balance. That's bank speak for what he's going. But these numbers that you're seeing here to the left of the screen is really what's happening here, that the economy expanding at 3.1% in the first quarter. That's much higher than the Bank of Canada was expecting. Jobs still strong, 41,000 created in the month of April. Also inflation picked up in April to 4.4%. That's over double the 2% guideline that the Bank of Canada would like. And also home prices increasing by 100,000 average for your average home across the country just since January alone. So what we're looking at market makers as well is, if you think this is not bad enough, particularly if you're owning debt. If you own debt, if you're not a saver, this is bad news no matter how you slice it. But they're already pricing in potentially another rate hike in July and perhaps another one after that, because inflation does seem to be acknowledged as a little bit hotter than the Bank of Canada and market makers out there think that it should be.
And that was kind of my next question in terms of getting to that target of 2% by the end of 2024. I anticipate, as you've just suggested, month after month, that is going to mean, it sounds like, a lot more pain.
Yes.
But in terms of immediate next steps, what happens next when it makes its way through the banking system?
Yeah, so first, the overnight interest rate is what big banks borrow at. So we're expect to see all the big banks across the country raising their overnight rates or their prime rates a quarter of a point. So this will affect immediately variable rates out there, lines of credit, credit card rates, so that is how it's going to trickle into the system, and hence that makes it more expensive for people to borrow. And anyone looking at their credit card statements or line of credit knows that how high the interest rates already are, because that's not the 4.75. They're paying much higher depending on the prime rate of those individual banks.
Thanks for this, Scott. That is Scott Peterson. And now for more on this, we reached Armin Yalnizyan. She is an economist and an Atkinson Fellow on the future of workers, and she joined us from Ottawa last hour for more reaction to that rate hike.
It was a 50-50 gamble whether they would pause or wait for a few more weeks to see what the European Central Bank and the American Central Bank, the Federal Reserve, was going to do. Both of them are acting next week, and our rates are... The Americans have got the highest rate right now, and they are still beating the drums for higher rates. So I would imagine that is the biggest reason to close the gap with the U.S. Central banks are working basically in lockstep all over the world to try and slow down their domestic economies. I was actually very surprised to hear that we went up another notch. We have not seen these rates since 2007. It's been a very long run of cheap money, and Canada started raising rates the first of any of the countries right now. So, and our inflation rate did titch up, but it's the lowest amongst all these other countries too. So, other than Japan, we're beating the band. In large measure, we seem to have contained the contagion of inflation. Yes, inflation rates did titch up from 4.3% to 4.4%, maybe the wrong direction, but the biggest increase in costs in that 1 month compared to a year ago was travel costs and mortgage interest costs. Guess who sets mortgage interest rates? The bank. So it's like, when you know that only a third of your variable rate mortgages have refinanced, and you've got, a good chunk of them out there waiting to feel the damage, we know that these decisions are very lagged in nature. And it's almost like you need more pain to bring the economy under control. I don't know why we need more pain, because their rates are only making things worse for the housing market. And that's where the biggest bite out of everybody's income, whether you're an owner or a renter, rich or poor, comes out of what's happening to housing prices, and that's a direct effect of the Bank of Canada.